Hello, hello everyone. Thanks for joining us tonight. We have a very great session tonight, and I'm really personally looking forward to tonight's session itself. So perhaps let me begin with some housekeeping matters. Right, we're going to release a poll shortly, so just need everyone's help to fill it up. Right, it'll be very interesting to see the poll results when they come in. Second thing is, if you have any questions, feel free to use the Q&A section in your webinar itself, right? So let's say you have questions about the content, or if you have general questions about the market outlooks, just post it at the Q&A and we'll get to it if there's enough time. All right, so let me just begin. Welcome for those of you who've just joined us in the last few minutes. Tonight we're going to be talking about opportunities in S-REITs with the lifting of COVID-19 restrictions. It's going to be a very exciting evening, right? And let me just quickly introduce myself. My name is Jason. I'm actually a senior wealth advisor here at Syfe. I spend the bulk of my time speaking to a lot of the Syfe users. I try and identify opportunities where I can actually add value into it. I also collaborate a lot with workplaces to introduce financial literacy, right? So maybe a shameless plug over here. If let's say you think that you want Syfe to actually come into your workplace to really speak about financial literacy, just feel free to let us know, and then we can arrange something from there. Right. So before I joined Syfe, I was actually in the precious metals industry for 6 years. Okay. And today we have Grace as the host. She's a very familiar face with everyone, I'm sure. Right. She's responsible for investment research here at Syfe. And before joining Syfe itself, she was a product specialist at Franklin Templeton. And prior to that, she was a research analyst with Barclays. Next on the list, we have Ritesh, who is the head of advisory with Syfe. So prior to Syfe, he was a private wealth advisor at Goldman Sachs. He was at Morgan Stanley as well. And he's actually holding an MBA from the Chicago Booth of School of Business. Okay, so before we go into the main agenda, maybe let me just give a quick overview summary of what Syfe is. So for those of us who are looking for at Syfe, we're actually a holistic, we actually try and provide a holistic solution to managing your wealth itself. We're actually a digital investing platform itself. And right now we actually have two arms. One platform is the Syfe Wealth, and the other one is actually the Syfe Trade. Right. So for us, our vision is to actually democratize investments, and we try to make it super easy, super affordable, and very seamless for anyone who's looking to actually kickstart their investments. Right. So on the wealth platform itself, we have curated portfolios that match individual investors' risk profiles. For investors who actually want to gain exposure to certain mega trends, we actually have customized portfolios, thematic portfolios that actually allow them to do so. Some investors also want to build customizable portfolios. We have that feature on the Syfe Wealth platform as well. Right, so I think it's a very good platform for investors to get in touch with. On the other hand, we have the Syfe Trade. So Syfe Trade is a digital platform as well, and is geared towards investors who know what they are looking for, looking to gain exposure to single stocks, I would say. And in a sense, they actually gain fractional ownership in companies based on value amount as well, not just based on lot sizes. So I think this is also a very nifty feature on the Syfe Trade itself. All right. Here at Syfe, safety is our #1 priority. Right, we're actually governed and regulated by Monetary Authority of Singapore. We actually hold a capital market services license, right? And this is very much like the gold standard when it comes to the money market management industry here in Singapore. Right. So what this means is that for our funds itself, we keep it separate from our clients' funds. So our clients' cash assets, they're actually kept into a trust account being held with DBS and HSBC. Right, and our clients' invested assets, they're actually held in custodian accounts with Saxo, Citi, and HSBC. Right, so essentially what this means is that Syfe, we will not be able to use our clients' money to fulfill our own company's operations itself. So this is the agenda for tonight. Before I hand the time over to Ritesh, he'll be going through the S-REITs, a review of it. All right, giving us an overall summary of what's happening in the markets. right? And then Grace will actually be going through the macroeconomic backdrop itself, headwinds and the tailwinds. And then Ritesh will actually finish it up with how can Syfe REIT Plus portfolio add value to you as well. So without further ado, let me introduce Ritesh. Hand over to you.
Hey, Jason, thanks for the introduction. So if we move on to the next slide, let's go and do a quick review of S-REITs, right? So, of course, Singaporeans, we love to invest into real estate, and it is therefore kind of no surprise that real estate investment trusts, or REITs, as they're popularly known, they're a very popular investment vehicle for Singaporeans since their debut in 2002. Now, what makes REITs a very popular asset class, and what does it mean to invest into a REIT as well? So a lot of, like I saw in the survey results, there were a fair bit of investors who are beginning their investment journey, or they're having intermediate knowledge. So we'll be happy to cover a little bit more about what REITs are. So think of REIT as an pooled vehicle through which you can invest into multiple properties, right? So REIT operate as a company, and then they have multiple, they operate as a company and they have multiple underlying properties that they manage. Now these properties, they are then lent out to, tenants who then give out rents to these, this company. And as part of the rental, that is the income that these REITs generate. Now, one special feature about REITs is that they enjoy certain tax benefits. They also enjoy certain attributes which are only applicable to REITs, and for them to get those benefits, they're required to pay out 90% of their income or profits as dividends to shareholders. So when you invest into a REIT, in a way you are taking kind of part ownership into one of these properties, and as the income is generated from the underlying property components, that income is then passed on to you, because 90% of the profits that are generated needs to be passed back to individual clients. Now, the other great thing when you think about REITs versus physical properties are, features that are specific to REITs. So for example, REITs are listed on the stock exchange. So what that means is you can buy and sell REITs, like a stock. And what that also translates into is that there is immediate liquidity. So you don't have to wait, right? When you invest into physical property and you want to sell out your property, you will probably need to wait for the right buyer, for the right price and everything, versus when you invest into REITs, it gives you a more liquid way to invest into real estate. REITs can also be more tax efficient. So for example, REITs, the dividends that you get as well as the capital gains that you get are tax-free, so you don't have to pay any dividends related tax on it. Versus when you invest into physical real estate, and depending on where you stay and all, there could be implications, specifically when there is rental income that you generate, there could be tax implications on those rental incomes as well. Also, REITs compared to physical real estate, like you invest into one property when you are investing into a physical space, versus REITs give you instant kind of diversification, because number one, as a company, each REIT is investing into multiple properties. But also when you invest into many REITs together, then there are REITs that are operating in different sub-segments as well, right? Like across sectors like healthcare, hospitality, industrial, and retail. So if we look at the Singapore REIT market and see where it stands, if we go on to the next slide, it basically tells us overall, Singapore is kind of a hub for REITs market, right? It's one of the largest, Asia's largest REITs and property trust markets, only behind Japan, right? So it is second largest in terms of the market cap, as much as $116 billion. In terms of price to book, so this is 0.97. Price to book usually measures whether a REIT is supposed to be undervalued or overvalued. So if the book value of a property is something and the price of the REIT is below that value, then essentially it means that the REIT value in the market is below par or undervalued. So 0.97 basically means that it is slightly undervalued at this point of time. Also, as I covered earlier, REITs give a pretty hefty dividend, as much as 6.1%. So if you look at the 44 REITs that are listed in the Singapore stock market, the average dividend yield is 6.1%. Also, the REITs market in Singapore is fairly diversified, right? It has exposure where you can invest into industrial REITs, you can invest into hospitality REITs, you can invest into retail and office REITs. These are things that you see more often, as you move around Singapore, like malls, retail offices, all of these kind of things. But what is more important to also understand is there are fair bit of representation from industrial, diversified, healthcare and related subsegments as well. So if we go on to the next slide, it talks a little bit more about where do the REITs stand in terms of the yield that you generate from it as well. Overall, the Singapore REITs market, as I covered, 6.1% is the current dividend yield. But even if you take the 5-year average, it averages around 5+%. And it makes the S-REITs market really, really attractive to both retail as well as institutional investors who are looking for income-oriented solutions, right? Because when you compare it against some of the other means through which you can generate income, you can potentially think of government bonds, where you don't have much credit risk, but the yield that you generate from it will be close to 2%, right? You can think of fixed deposits, but nowadays, even when the rates are supposedly rising, you can't get more than 1% on your fixed deposits. Plus, these fixed deposits come with lock-ins and limits as well. If you compare REITs with, say the broader Singapore equity index, which is the STI index, even that one, like maybe from a risks perspective, they're roughly similar, but the S-REITs market gives more than double the kind of dividends that you get from the STI index, right? So that, I think, puts REITs in a very special category in terms of generating income. And the good news is it's not just the income where the S-REITs market shine. When you also look at the overall returns of the S-REITs market, the S-REIT markets tend to do much better than the overall, say, the equity index in Singapore as well. So if you're looking for an income solution which can give you, fairly consistent dividend yield, and you want that to persist over time, S-REITs, and you wanted it to be also in Singapore dollar denomination, then S-REITs definitely would be one of the top choices for people to consider as part of their income generation as well. If you go on to the next slide, which talks about the sub-segments within REITs, and what you see is obviously retail, office, and some of these segments have much higher dividend yield. There's also reflective of kind of the price corrections that have happened into these segments over the last couple of years, because during the pandemic and with work from home arrangements and online related activities going up, retail and office REITs did take a beating in terms of their valuations and their prices. But right now, as we are headed back into the reopening, and this will be covered later on when Grace speaks about the broader macro outlook, you are seeing a recovery in these cyclical segments such as retail and offices. And what that means is, like, while the dividend yields are pretty attractive at these current levels, there is also a potential price appreciation that you can look forward to. Other than that, the more stable kind of yield, subsegments would be your industrial, your diversified, your specialized, and healthcare. So these are more of the, evergreen sectors, I would say, because when you look at, say, the secular growth trends that are emerging in the market with respect to, say, data centers, logistics, healthcare related aspects, these are segments that will continue to grow as we move on. If we look at the next slide, it talks a bit about REITs as a perpetual income generator, right? And how the REIT dividends have been very, very resilient even through COVID-19. So of course, through the COVID period, the dividend yields of REITs came down. But if you look at the range of dividends that you've received over the last, say, 5 to 10 years, the range has not fallen below 4.5%, right? So the lowest that it has gone to is 2020 when it dropped to 4.5%. But on a 5-year average, you're seeing a dividend yield of close to 5.2%, right? And the 2022 estimated dividend yield for the REITs market, and more specifically for our REITs portfolio that we'll talk about later, is 5.5% as well. Just a quick numbers thing here, like if you are someone who's looking to generate an income and you're looking at a solution which can give you a certain amount of income as well, REITs can definitely be a part of that portfolio. So for example, if you want to generate, say, $1,000 a month on your income from an income perspective on a regular basis, you need roughly around 250,000, right? So now, I mean, a lot of us might not be at that stage where we need that $1,000 a month, but say you need that $1,000 a month 10 years down the line or 20 years down the line, you want to have a more financially independent life. You can start off small by investing into REITs and reinvesting these dividends back into the portfolio as well. And over time, what will happen is as your REIT portfolio grows, and suppose you reach say $250,000, 250,000 multiplied by 5% is 12,500, which you divide by 12 will give you that $1,000 a month kind of passive income, right? So that's the way a lot of people, especially the older age demographic folks who are looking to generate an income, they would kind of back calculate how much do they need to invest into REITs to generate a certain amount of income. If you go on to the next slide, it also highlights the aspect that the REITs market, and specifically the S-REITs market in Singapore, gives you pretty high dividend yield, but it is also very efficient in terms of returns and risk as well. So while the distribution yield is fairly high, what you see is on the volatility side, it is one of the lowest volatility compared to a lot of like global indices and global REIT markets as well. So if you look at the STI index, it is half the dividend yield and roughly double the volatility, right? So volatility is a measure of risk that you're taking. Similarly, if you're investing into, say, the US market, Dow Jones International, the risk is lower, but the returns are very, very low as well. And similarly, if you look at the broader US REIT market and say the Hang Seng Index and other such indices as well, typically they will either be lower return at higher sort of risk, or slightly higher return, but that also means you're taking much, much higher risk too. So given the overall market situation where we are right now, I think S-REITs definitely are a very, very attractive yield generator, but not just from a yield standpoint, but also from a total return standpoint. Given the current macro backdrop that we have, it will be interesting to know what are the current headwinds and tailwinds that are going to impact the REITs market, and what does this imply from a positioning standpoint as well. So I'll turn it over to Grace to cover those aspects.
Yeah, thank you, Ritesh. Before I start, I think if we can run 3 more polls. Sorry, excuse me. So this is more, yeah, and thank you for those who answered the previous 2 polls. I think that's very helpful for us, just internally as we plan these sessions, and also think about how much time to spend on each section, depending on how long people have been invested and like their investment knowledge. The first question here is, do you currently own the home you live in? The second one being, with the lifting of COVID restrictions, what are your travel plans for the next 12 months? And then lastly, for those who are working, the lifting of the restrictions again, will you be heading back to the office, and kind of what's that arrangement like? Yeah, as we sort of wait for that to go on, and then we can look at the results later on as we have more responses come in. Jason, do you mind going to the next slide? Okay, yeah, so as Ritesh mentioned just now, and as you've seen in the charts as well, S-REITs and I think even Singapore equity, right, as measured by the Straits Times Index, it's done pretty well as compared to the global counterparts. So these 2 asset classes are represented by the top 2 lines, so the blue one and orange one. And I think something else that's quite, I think you would expect to see that somewhat similar in trend, right? Because both cover like the Singapore market. But what's quite interesting is, even if you look at the gray line, which is the North America REIT, and then S-REITs, right, both are on the uptrend. So these are the top 3 lines if you sort of see it from the right. And REITs have been quite resilient, lately, even as like global equities and US equities have had a challenging period. So in the next slide, I'll just go into the headwinds and tailwinds that we think are that the asset class faces, and also our view on them, looking at the data that's coming in, and also looking at past scenarios where we've seen similar type of like investing environments. All right, so the first headwind, I think this is not a surprise to most people, is just higher interest rates. So we've seen the first rate hike, and then in about 2 weeks' time, the FOMC will meet again, and we might get sort of like a double hike where the interest rate will get increased by 50 basis points and still 25 basis points. And what this could mean for the market more broadly, we'll cover in the next 2 slides. The next headwind is stagflation. This is an environment where there's inflation but low growth, and in some occasion like negative growth. And then the tailwinds, on the other hand, it's reopening and then a resurgence of economic activity, not just in Singapore, but also regionally. And then lastly, some of the pandemic type of investment, or not really investment, but consumer behavior that we think will carry through to the next few years. So going into rate sensitivity. Oh yes, and we have the responses now. Oh, thank you. Thanks for everyone for answering. Yeah, quite interesting. So about 2/3 own the home they currently live in, and the remaining third don't. Yeah, it looks like everyone is thinking about traveling in the next 12 months. Oh, and good to know that for the last question on this work arrangements, about half would be in a hybrid type of scenario. Cool. Yeah, thanks everyone for answering. Yeah, it'll be interesting to like so see how this folds into the rest of our so we have some statistics on offices and just kind of the return to work trend that we will cover too in the next few slides. All right, so back to rate sensitivity. So REITs, along with many like other capital intensive sectors, are sensitive to interest rates, given its impact on borrowing costs and yield spreads. So S-REITs have been managing their interest rate exposures actively. So according to SGX research, about 3/4, like 75% of S-REITs, their current debts are either in fixed rates or they're hedged through floating to fixed interest rate swaps. So this is a bit like, if you had a mortgage and you have a fixed rate, right? So even if the interest rates increase, you wouldn't be paying a lot more in interest costs, over time. And in addition, S-REITs currently have an average gearing ratio of 37%. This is below the regulatory threshold of 50%. This is a bit like for these companies, it's like, if you're a consumer and you have a mortgage, this is like the total debt service ratio. It's employed in a very similar way. They don't want to have these REITs take on too much debt that potentially that they might have some trouble servicing. So this threshold is 50%, and then currently REITs are about 33% below that. And this, it measures leverage. So it's total borrowings by total assets. And a lower gearing ratio, like a lower TDSR, would just mean that, they have pretty good interest coverage. And then these S-REITs can service their debt and still have room to raise more debt, if and when they need it for acquisitions or to expand operations. This tables in particular, we look at the correlation to U.S. Treasuries. Right? So correlation measures whether these two kind of trends that move in the same way. Looking at daily data over 1 year, 2 years, and then weekly data over 3 years, the correlation of S-REITs and U.S. Treasuries are very low. And then so to compare, S-REITs versus STI, you do see a much higher correlation, right? Because they tend to be more like susceptible to the same factors and the same like driving forces. Okay, we go to the next page. Looking at the periods in the past where the Fed funds rate has increased along with the 3-month SIBOR rate. This is a rate where a lot of mortgages are pegged to. The performance of S-REITs have been mixed. So in the first time period, that was the taper tantrum of 2013. So this was when the Fed was going to increase rates, and then everyone was like, oh, we're not quite ready yet, right? So in that scenario, S-REITs fell about 17% over 9 months. And then in 2015, when the global market had a huge sell-off with the Greek debt default, and then a sharp fall in petroleum prices and slowing growth in China, S-REITs fell about 9% over 8 months. And then the third period is when we actually had a Fed funds rate increase along with subsequent increases along the yield curve. So for that time period, it is quite long. So it went on for almost 4 years, and REITs did really well, about 73% cumulative over that time period. right? And then more recently, we've had the first rate hike last month, and S-REITs did quite well. Like, so it was like a non-event. It still made about 3.4% over the last month, right? So what was different in 2013, 2015, the 2016 period, 2019, and then now? And I think ultimately, like whether there's growth, like growth matters here, right? Economic and earnings growth drive equity returns, and similarly, like economic and rental income growth would drive returns of S-REITs. So now that we are, like about a quarter of the way, more than a quarter of the way through 2022, and 2 years behind the pandemic started, like things are looking quite good for S-REITs, and we'll go into that in more detail in the next few slides. Inflation. So this is something that I think everyone has been hearing a lot about. And I think it was just a few days ago where the CPI was 5.4%. And we want to show some analysis done comparing the North America REIT versus S&P 500. So in Singapore, because we haven't really had a period, a sustained period, where inflation has been above 2.5%. And so we sort of used a proxy in order to do this analysis. So if you compare, S-REITs, if you compare US REITs versus S&P in different inflationary periods, going from like low inflation, where inflation was below 2.5%, to moderate, which is like 2.5 to 6.9%, and then to high inflation, we see that, S-REITs have performed, REITs in general in the US have performed well when inflation is moderately high. So that's the 2.5 to 6.9% type of environment. And we would expect a similar trend to play out in Singapore too, right? So income from real assets like REITs are tied to inflation. So as leases and like streams of revenue increase, that gets passed on as income. So as economic activity increases, rents rise, utilization of these properties improve, and the benefits are passed on to the investor. Yeah, thank you. Next slide. So we get asked this quite a lot, right? Like, what's the best way to beat inflation? And the answer is that you have to be able to grow your wealth at a rate that's higher than inflation. Singapore REITs have managed to do this. So we look at the last 10 years, the compound annual growth rate, so the CAGR, was 13%, right, compared to about 2% for inflation. And looking at like dividends and income returns specifically, which Ritesh shared earlier, the 5-year average is about 5.2%, and that also outpaces inflation. Go into economic factors, there's some indicators mixed. Yeah, so this was announced in February, but the full year like GDP in 2021 was 7.6%, and this year MTI is expecting about 3 to 5%. And this was so I saw this yesterday that the Q1 GDP figures will likely be upgraded higher because of better than expected like factory output in March. And on the unemployment or the employment side, we've seen job vacancies still be quite elevated, so about 200 vacancies for every 100 unemployed persons, and then the unemployment rate is about 3%. CPI, like we covered previously, it's 5.4%, one of the highest in 10 years. But REITs being having an inflation beta of more than 1, it can be a good growth inflation hedge. Yeah, let's go on to the next slide, which shows the worldwide reopening of economies. So we've seen a reopening in Singapore, particularly in this week when restrictions were loosened further. But high frequency data shows that it's been a similar level of increase in activity, elsewhere, like globally, compared to pre-COVID-19 levels. Yeah, so we have the reopening schedule aligned to the momentum of the region and the rest of the world, like India, Korea, Malaysia, Taiwan. They've all also loosened restrictions. And then domestically, right, with the easing of measures such as group sizes, and then allowing for the sale and consumption of alcohol after 10:30, we think that these will be pretty strong tailwinds for the sector. And then lastly, on the office side, I think previously it was like more than 75%, and now it's up to 100%, right? So the CBD area is again very busy and very active. And I think some may have questioned like the long-term utility or like value of office buildings. As we do see that most people are still on hybrid or going to move to hybrid. But what happens in the office space is that there has been like a really high pace of growth in the last quarters compared to before, and the falling in vacancy rates. And there has been also kind of like a bifurcation of like higher grade offices, as companies feel like they have to kind of really provide a nice working environment for people to come to work, and also more mixed use developments are taking over older properties and, like, integrating spaces where people work, live, shop, and dine. Yeah, so on office space, yeah, I mean, you've seen this this chart, the changes in net demand and supply during the pandemic, and also a bit more recently in 2021. And I think something that's a bit more recent is the Q1 2022 data in the table. So the price index and the rental index have both sort of turned around. That's been an inflection point. And according to SGX research, like building valuations for some of these higher grade office spaces like the Marina Bay Financial Center towers, One Raffles Quay and Keppel Bay Tower have also increased with higher rental rates. On a year-on-year basis, office rents increased by about 1.9%, 2021 after falling 8% in 2020. According to Cushman & Wakefield, the real estate management firm, rents are expected to grow about 4.6% on a year-on-year basis in 2022. And this comes on the back of rather limited new office supply, and also just aging buildings that have been taken offline for redevelopment, right? And then with more like flexible office space and like some more tech companies moving to Singapore, we also see that there has been a growing demand for that. Next is industrial. So investors have typically, traditionally associated industrial REITs with warehouse facilities and industrial buildings, but now they are pivoting into like more specialized new economy assets like business parks, modernized logistics spaces and data centers. And such assets grew in demand during the pandemic. We expect this trend to continue. Outside of Singapore, just talking more globally based on the research that we've seen, the top 10 technology companies, they all have a market cap of like more than 100 billion and all have operations in Singapore. But beyond this top 10, there also been growing technology companies like LinkedIn, Twitter, Uber, Airbnb, Booking.com, Expedia, like these type of leisure type sectors that have been doing quite well. They all have offices or they operate in like CBD or CBD fringe. And next we go on to retail. We've compiled data for retail REITs with market cap of more than 500 million and found that the average yield has increased in the last 2 fiscal years, albeit from a low base in 2020. We expect this trend to continue as well. So from Suntec REIT's annual report, very recently, tenant sales in late 2021 during the holiday season were better than that in the same period in 2019, right? So with reopening, we're also expecting to see a shift in spending patterns at shopping malls. So in the last 2 years, like things like grocery stores did really well, and more people make their own meals. But more recently, it's been more difficult to get a reservation, and we expect dining in volumes as well as sales to increase with larger group sizes and then no time limit on last call. In 2021, retail REITs along with industrial, one of the best performers. And the last point, just want to talk about the demand and supply, because we've definitely heard about supply disruptions, not just for HDB, but just for the construction sector as a whole. So new construction has been disrupted. And this actually provides somewhat like a protective envelope around real estate, right? Because you have low new supply coming in and growing demand. So it's a pretty good backdrop. Sorry, excuse me. Yeah, so in this chart, from 2015 to about 2020, you see that the net lettable area is about 1 million, but going forward in the next 3 years, it will be a lot lower, right? And the new supply is concentrated in like suburban and fringe areas where there are well-defined population catchments. So this is where people tend to live. They tend to like go to the regional malls during the weekends, and we can like, even though supply is tight, like these are going into the areas where people are, and so we expect like the rental and the tenant revenue to do quite well. Yeah, so overall, if I could summarize just what we talked about the risks and opportunities. So there are, some risks to the outlook, but on interest rate risk, S-REITs are not as sensitive to US rates, and when there is growth and inflation, REITs tend to do quite well. And then on stagflation, I think this has come up a while more recently, and we have inflation, but recent events are unlikely to derail growth completely. And given that REITs have an inflation beta of more than 1, this means that they are a good hedge for inflation. We think that they will continue to play that role well. And lastly, on supply disruptions, and then an increase in economic activity. So we're seeing that supply disruptions are actually not bad for the sector, and it helps to support valuations in the short term. And then again, green shoots across various REIT sectors like retail, industrial, and office. And now I'll hand it over to Ritesh.
Hey, Grace, thanks for that. Do we want to take a quick pause and see if there are any questions? Jason, anything so far?
Ritesh, so far we do have one question. So this question I think is a little bit general, right? So I think the participant is asking, like, in terms of the REITs wise, should they be looking at S-REITs, or should they be actually looking at US REITs, or even a combination of both in their portfolios?
Yeah, that's a good question. See, generally as an income investor, and if you want to take broader diversified exposure to the REITs market, then yes, you should have exposure both to Singapore REITs and even like globally. Having said that, the Singapore REITs themselves are fairly diversified as well. Like we covered the different subsegments that you get exposure to. Plus, on top of that, the REITs themselves are spread like predominantly in Singapore, but also like regionally. Plus, some of the REITs do have US and European exposures as well, right? So through Singapore, you can still achieve a globally diversified portfolio by investing into S-REITs, right? So that's number one. Number two, in terms of returns, there has been a divergence in terms of returns between S-REITs and the US and other global counterparts. So the S-REITs market was fairly range bound for the bulk of 2020-21, mainly because we went through periods of uncertainty, and there were frequent regulatory restrictions that were put in terms of like movements and stuff like that, versus the broader US markets and global markets started to open up, taking the virus into stride, and they said that we will live with the virus. Now Singapore came a little bit late to the party, but I guess now Singapore is opening up in a pretty big manner. And on top of that, the economic indicators more locally are very, very supportive as well. If you put those into perspective, and considering the global macro backdrop and the geopolitical and the other risks prevalent outside, in a more localized context, the Singapore REITs are starting to outperform their global counterparts. Also, the valuation gap that we had between the US REITs, which moved in tandem with the US equity markets, now are kind of tapering down a bit compared to the S-REITs market, which we saw like in terms of price to book ratio, the price to book is 0.97, so a bit undervalued from a valuation standpoint as well. So I mean, yes, I mean, I'm fairly optimistic about the S-REITs market. I think it was kind of long due in my opinion, but we are seeing now the S-REITs market, going in the right direction.
Thanks a lot, Ritesh. We do have more questions coming in as well. For those of you who haven't posted your questions, please feel free to post more questions as well. Perhaps we could go on with the next part of the webinar as well, Ritesh.
Sure, yeah, let's go into the next section, right? So how does REITs, or Syfe REIT Plus can add value to your portfolio? Let's first cover the broader suite of offerings that we have on our wealth platform. So if we go on to the next slide, we have both the Syfe Wealth platform as well as the trade platform. On the wealth side, we have our core portfolios. These are our flagship portfolios. These are portfolios that you should start your investment journey with. They are globally diversified across asset classes, equities, bond, gold, commodities, all are kind of mixed together. And depending on your investment time horizon, depending on your risk appetite, you can choose a lower risk portfolio, basically meaning a more bond heavy or gold heavy kind of portfolio, versus if you are having a more longer term time horizon and have a higher risk appetite, you can go for the more aggressive options, which have higher equity proportions, which means that you can capture more growth, but it also means you are ready to take additional risk to kind of go through those periods of uncertainty. Now, on top of the core portfolios, we have specific portfolios that cater to the needs and requirements of our clients. Plus, there are ways to personalize your portfolio through our thematic offerings. So the REIT Plus portfolio is a really need-oriented portfolio that we have generated, or we have solved for. It gives you access to the top REITs in Singapore, and it is built in partnership with the Singapore Stock Exchange, gives a pretty hefty dividend yield of 5.5% for the current year. And again, it's a great way to get income in SGD denominated terms. And alongside income, the good news is because REITs also capture the growth potential, so you can look at a combination of income and growth when you're investing into the REITs market as well. We have the thematic portfolios as well. These are portfolios where you want to participate in the future mega trends. We have created ready-made solutions where if you want to invest into the future of technology, into healthcare, into, say, you want to take a positive view on China, that the market has been beaten down quite badly and there is going to be a recovery play. So those are specific aspects that you can incorporate in your portfolio as layerings on top of your core allocations. So that's what these thematic portfolios solve for. On top of that, we have the custom portfolio builder. So you could be someone who wants to create your own portfolio and you want to see how the exposures and all look like, what are the past returns of these portfolio, and you want to automate your investment process. That's where custom portfolios come into play, where you can create your own portfolio with your own kind of weightage definitions as well. We do have the cash plus portfolio as well. This is kind of an entry level portfolio where if you just want to make your money work a little bit harder than what you get in your bank account, you can put your money to here. It gives a projected return of 1.2%. The good news is there is no lockup, there is no minimums, and you can, full liquidity, right? You can take your money out at any point of time. So these are, fairly popular across the board, all these portfolios. And depending on what you're trying to solve for, are you trying to get a better yield on your savings? Are you trying to get a better income? Are you trying to grow your wealth? Then you can go to these different offerings and accordingly, take them. On top of that, we have the Syfe trade platform. So here you can DIY and invest into individual securities, mainly listed on the US Stock Exchange right now, but we are going to expand this offering more broadly as well. Let's now look at the S-REIT market and the solution that we have built, which is the REIT Plus portfolio. Now, the REIT Plus portfolio tracks this index called IHS REIT Leaders Index. This index is created by SGX, or the Singapore Stock Exchange, to track the 20 largest and the most liquid REITs listed on the Singapore Stock Exchange. Now, the Syfe REIT Plus portfolio aims to closely replicate the performance of this index. And the fact is that you cannot directly invest into the index, right? So products like our Syfe REIT Plus provides an indirect way for you to get exposure to the top REITs in Singapore in a very seamless manner. In terms of the index itself, the way the Leaders Index has been constructed, it's a market cap weighted free float index. It measures the performance of the largest and the most liquid REITs in Singapore, and it is diversified across sectors and subsegments as well. So if you go on to the next slide, it talks about the different REIT subsegments that the IHS REIT Leaders Index invests into. The top 10 constituents, you can see that there is diversification and allocation to the more retail, office, commercial space REITs, but there is also a fair bit of allocation to your logistics, your new economy like industrials, your data centers, and other such subsegments as well. As a whole, industrial and warehouse REITs compose as much as 46% of the iEdge S-REIT Leaders Index, right? So fairly diversified, and the fact that like retail, office space are on that cyclical trend going back up, if you are investing into it, you capture the more secular growth trends through these industrial data centers, warehouse, healthcare, all of these segments, but you also capture the cyclical, subsegments, which are your retail and office spaces, which were particularly beaten down in 2020-21, but now are staging a very quick recovery. So if you go on to the next slide, it talks about the two specific offerings that we have. So the Syfe REIT Plus basically gives you two options. One is you can invest into 100% REIT portfolio. So this portfolio basically tracks the iEdge S-REIT Leaders Index, as we talked about, right? It has generated an annual return of more than 9% over the last 5 years and has a very hefty dividend yield of 5.5% for 2022 estimated. And as we covered earlier, it gives you access to the largest and the most liquid REITs in the Singapore market, including the A-REIT, Maple Trees, Capital Lands of the world. There is also an option of investing into a risk managed REIT portfolio. So this particular portfolio combines the 100% REIT portfolio, but has some allocation to Singapore government bonds. And the way it works is because the Singapore government bonds are lowly correlated to the S-REITs market, typically when the markets are uncertain and all, this portfolio has lower drawdown compared to the 100% REITs portfolio. Of course, because it's a lower risk portfolio, the returns of this portfolio are slightly lower compared to the 100% REIT portfolio. So it is 8.4% on a 5-year average basis. And the dividend yield is slightly lower as well at 4.3%, right? If you go on to the next slide, it talks about the performance of these two portfolios. So from a long-term historical standpoint, if you look at the last 10 years, of course, the 100% REIT portfolio on a total return basis is close to 9% annualized return versus the risk managed REIT portfolio is around 7.9% annualized return over the last 10 years. But if you consider the more short-term aspects of these portfolios, particularly the period of 2020, what you'll realize is this golden line, which has fallen through lesser, right? So the REITs with risk management fell lesser. And what that meant was it was much more stable through the pandemic. The 100% REITs portfolio fell by a larger amount during the pandemic, but the recovery is a bit stronger as well. And that's why you now see that as we reopen the economy and everything, the blue line is going above the yellow or the golden line, right? So over a longer term, the higher risk that you take with a 100% REIT portfolio should translate into higher total returns as well. Now, this 9% annualized return, the way to break it up will be, part of this return is the dividends and part of the return is the price appreciation of the REITs. So if you look at the dividend yield of the portfolios for both the 100% and the risk managed REIT portfolio, the 100% is at 5.5% and the risk managed is at 4.3%. And even historically, usually the 100% REITs portfolio will tend to give higher dividend yield. So out of this 9%, the way to read it is the total return on a historical basis, long term is 9%. Out of that 9%, around 5 to 5.5% can be attributed to the dividend yield part of the return. And the other, say 3 to 4% can be attributed to the price appreciation of the REITs as well, right? So that's why REITs can be considered as a combination of income plus growth. In the short term, the price can fluctuate. What that means is there is some principal, fluctuation that you can see. But if you're investing with a long-term intent, say 5 years, 10 years and all, then you get a dual benefit, the dual benefit of generating a stable income in form of dividends. And on top of that, price appreciation due to the growth of REITs as well, right? So that's why you see a total return of close to 10% when you look at the longer term returns of the REITs portfolio. Now, if you look at the Syfe REIT portfolio with certain other ETFs that are available, if you go on to the next slide, it talks about the benefits of using Syfe REIT Plus, right? So number one, we track the index very, very closely. The tracking error is very low. Plus the fact that with the REIT Plus portfolio, you don't really need to create another brokerage account. You can just, come in, sign up and get started. We auto rebalance the Syfe portfolio, right? So as the index changes, we kind of rebalance the portfolio and realign it to the index automatically. There is no cost to that, rebalance. versus the REIT ETFs, where some of these are not incorporated as seamlessly. The dividends are automatically reinvested. It's a very powerful feature, in my opinion, because if you are a young investor, you might not need that income right now. You might need it like 20 years down the line. So you would want to reinvest that dividend back to the portfolio. For an ETF, you will need to manually do that, or it will be inefficient because you will run up into minimum brokerage costs and all. Versus the REIT Plus portfolio, it is automatically reinvested. And in fact, it adds another 0.5% return to your overall REIT portfolio returns, versus if you don't reinvest the dividends. The management fee that we charge is starting as low as 0.35%, versus the REIT ETFs, typically the management fee is higher, up close to 0.6 to 0.91%. And again, the liquidity part of our REITs, you're directly buying the underlying REITs, so there is no two-layer liquidity that you need to solve for, because for a REIT ETF, first you're subject to the underlying REIT, individual REITs liquidity, and then you're subjected to the ETFs liquidity as well. If you go on to the next slide, comparing REITs with owning a second unit. So this is very interesting, right? Because like all of us Singaporeans and Asians in general, we love to invest into property. Now the question is, if you have the money, would you invest it into a physical property, or would you invest into REITs? We covered some of these things earlier as well, but it is very, very apparent, like the minimum investment that you need for a particular physical property, it will be much, much higher compared to REITs, where you can get started at very, very low amounts. The rental yields of typical physical properties right now is close to 3% versus REITs 5 to 5.5%. In terms of taxation, again, REITs are much more tax efficient. There is no rental income tax that you have to bear when it comes to REITs. At least from a distribution standpoint, you get the full dividends attributed to you. In terms of cost, there is time that it takes, there's financial costs and all as well, paperwork and all that is needed to invest into physical REITs versus in REITs, physical properties versus REITs, you can just invest directly. There are liquidity aspects that you need to consider, because if you are investing into a property, if you want to somehow liquidate it for some reason, you will need to wait for the right buyer. And if you want to sell it at a fairly quick pace, you might need to make a compromise in terms of the valuation that you get. And then, yes, capital appreciation is there as a potential for both the aspects. In terms of diversification, typically physical real estate, very concentrated because you only have one or few units, versus REITs, you can diversify across sectors. So the question is, how much income can you generate, and how much money do you need if you want to generate $1,000 a month, right? So if you go on to the next slide, it captures that aspect of, for different amounts that you invest into REITs, what is the kind of monthly income that you are generating? So if you're investing 25,000, that's roughly at a 5.5% dividend yield, you're generating close to $100 a month. And as you increase your quantum of investment into the REITs portfolio, the income keeps increasing. So if you're solving for $1,000, you need roughly $250K to invest into REITs. And again, this is just the dividend portion of the return. It doesn't take into account the capital appreciation that also should come on top of it. In terms of the fees that you're paying onto the Syfe platform, we go on to the next slide. Essentially, there is no minimum for you to get started. Of course, if you invest more, the fees keeps coming down. The management fee drops from 0.65% all the way to 0.35%. The cash plus portfolio is free of cost, so there is no management fee there. If we go on to the next slide, by the way, this cost actually includes almost everything, especially for the REITs portfolio. There is no trading fee. Like, we bear the cost of brokerage when it comes to buying and selling of REITs. There is no entry fee. There is no exit fee. There is no minimum balance. Because we are buying the REITs directly, there is no two-layered fee that you're paying, right? Because typically, if you buy a REIT ETF, then you are paying, the brokerage fee to buy the REIT ETF, and plus you're paying the annual, management fee of the REIT manager. So the expense ratio of the REIT, and plus if the platform is charging another fee on top of it, that just increases the overall cost of your investments by a hefty amount. So for the REITs portfolio, essentially, you are directly investing into the underlying REITs, and we bear the brokerage costs and everything, and even the rebalancing costs are borne by us. So basically, it means that 0.35%, if you're investing in as a private wealth client, is an all-inclusive fee that you're paying to us. On top of that, if you have your specific situation and you want to talk to us, from an advisory standpoint, feel free to reach out to us. Jason and myself are part of the advisory team. So do reach out to us through our website. There is a wealth advisory section where you can schedule a free consultation call with us. And thanks everyone for joining in today. As a token appreciation, if you have not yet signed up, you get a 6-month fee waiver for your investments up to 50K. So you can use this code Syfe webinar. And for any investments that you do for non-cash plus portfolios, you can get 6 months of fee waiver up to $50,000. All right, so we'll just pause here for a bit. We'll move on to the feedback section. So please feel free to give us some feedback, things that you would like us to incorporate and improve upon. Happy to take those. And at this point, we'll just open it up for a couple more questions. Jason?
Yes, thanks a lot, Ritesh. We do have very good questions coming in fact, and honestly, I have no idea how we're going to try and complete all these questions because they are all so good. All right, so maybe let me just dive straight in. I think perhaps this is one of the top questions on our mind when it comes to physical real estate itself also. So will climate hazards such as earthquakes or floods actually affect REITs? So I think the person who is asking this is actually referring to countries where it's very prone to climate changes. Like I think there was a recent flooding in Malaysia. Right, so I think essentially the question is, will climate hazards actually pose a risk to REITs itself?
Yeah, so I think generally these things are beyond our control, but yes, I mean they will have implications, and especially if your portfolio is concentrated, right? And that's where I guess investing into a physical property versus investing into a REITs based portfolio makes all the difference, because typically there are 2 levels of diversification that are built in when you invest into REITs, right? So first is each individual REIT that you invest into, they have multiple properties, and they typically, a typical REIT manager will have properties not just in one country, but they'll have it spread across, multiple countries as well. So that's one level of diversification. The second level of diversification is when you invest into a portfolio of different REITs, then naturally you then further diversify yourself. So yes, I mean, if you have a concentrated portfolio and, God forbid, something bad happens to that particular region where your physical property is, or, a particular REIT manager has his concentrated portfolio, and there could be implications. But if it is a broadly diversified portfolio that you're investing into, then I wouldn't be that worried.
Right. Yeah, if we could just add very quickly to Vitesh's point, right? So in Syfe REIT Plus, we track the 20 largest, and what this means, let's say something happens to your data center in Sri Lanka, right? And then the thing is, a lot of these larger REITs are very well capitalized, so they might take it offline for a while, right? Fix it, see if they can fix it, and then they will sort of put it back online. And I think investing in, besides diversification, but also going for the ones that are well capitalized, it means that they are able to fix the problem, right? If it comes, but of course, assuming that it is fixable and not something that's extremely catastrophic.
All right, thanks a lot, Grace, for chipping in there. The next question we have is also something that I think is very prevalent in recent months. Martin is actually asking, so S-REITs have actually been very active in raising money by the rights issues or even preferential offerings. How would this actually impact S-REITs?
So I think rights issues, it's offered to existing owners of investors of the REIT, right? So you get to, and normally rights issues happens when the REIT have already identified a prospective property that they want to add to their portfolio. And then they're asking investors would you like to subscribe, right, to sort of participate in the growth potential of this? And it's offered at a discount, right, to the price. So the existing investors get a bit of a discount. So the discount ranges from maybe 2 to 8%, depending on the property and the issuer. So depending on the risk, right, of whatever that they're acquiring. So let me just go back to the second part of the question. Yeah, and they're not factored into dividend calculations. I mean, eventually they are, right? Because maybe as they acquire it, they have to fix it and make it sort of increase the value proposition of that property. and then eventually they will let it out, to tenants, and then depending on like what type of property it is, so that could be so there'll be like a flat rate, right? And then there'll be another component that's based on just revenue of the tenant. So eventually, like, it does count towards your dividend return, but it's mostly just used as a mechanism for them to grow their portfolio and to like diversify into either a different area or a different sector in many cases.
All right, thanks a lot, Grace. Okay, another question. I think we actually went through this in the webinar earlier, but perhaps to re-emphasize the point or bring this question up. So the participant is asking, in this current inflationary environment, I mean, a lot of countries, you talk about the US hike rates as well. Is it still good to go for REITs? Will it actually be beneficial to my portfolio itself?
Yeah, so I guess like the main aspect is like REITs tend to be a growth inflation hedge. And what that means is if there is inflation in the market, but it is also combined with decent growth, then REITs tend to do much better as a whole, versus if there is inflation, but there is, global concerns about growth, that's where, you would be a bit worried as a whole. But given like what Grace had shared earlier, the reopening of Singapore and the economic outlook and the GDP numbers and the unemployment numbers and all, those trends are really, really positive from a Singapore and local markets perspective. What that means is, yes, there is inflation, yes, the interest rates are moving up, but given these other, more positive driving factors, the broader outlook for REITs is also much more positive going forward. So that's how I would characterize it. I think there was this one slide where we compared the performance of REITs as a whole to S&P 500 under different inflationary regimes. So there was a low inflation regime, there was a moderate inflation, and there was a high inflation regime. And both under moderate and high inflation regime, the REITs tend to do much better as an asset class compared to the stock market. So if you are looking to kind of rationalize your portfolio and look at better kind of positioning given the rising inflation environment, REITs could definitely be part of that allocation given the current backdrop as well.
Thank you, Ritesh. And if I can just add, I think it always helps to sort of like think of it in a more tangible way, where, let's say assume you have like one unit, a residential unit that you want to let out. Do you think that there will be demand for it, right? And then also how much do you expect to be paid if you rent it out? And then if you add additional layers, so for instance, if you're letting it out to a shop, like a commercial venue, then there is that sort of flat rate, and also anything that's based on how much they make on a revenue basis. So overall, like if there is demand, right? If demand is still going to be maintained, like even in 2021 levels, and now we think that demand might actually increase. So REITs have been quite resilient in the past, but also I think right now, with just like green shoots and these tailwinds, I think it'll be quite supportive of the outlook.
Okay, all right. Thanks a lot, guys. Thanks a lot, Grace. Thanks a lot, Ritesh. And of course, thanks to the participants. There are still questions that are unanswered at the moment, and regretfully, we have run out of time already. So once again, thanks everyone for this evening. I hope we had a very enjoyable 1 hour session over here. Look forward to seeing you guys again. All right. Thank you, everyone.